Ladies and gentlemen, good day and welcome to the Iifl Finance Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to the management. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Team Iifl Finance, I thank all of you for joining us on this call. I am Rajesh Rajak, Chief Financial Officer, accompanied by Mr. Nirmal Jain, our Managing Director, Mr. Monu Ratra, CEO at Iifl Home Finance, and Mr. N. Venkatesh, CEO at Iifl Samasta Finance. I'll now hand over to our Managing Director, Mr. Nirmal Jain, to comment on the economy and the group's overall strategy and plan. Over to you, sir.
Thank you, Rajesh. Good afternoon and welcome to the analyst call. So macro environment, as we all know, the global environment is turbulent. Yesterday, Fed hiked the rate by 75 basis points, which was a little aggressive, but maybe most people say that was much required or called for. Markets rallied maybe for a variety of reasons, but the fact which very few people doubt is that there is an imminent slowdown or recession in the developed world, and particularly USA and Europe. So the global backdrop is worrisome. But in that backdrop, if you see India, then the underlying momentum in the economy is very strong. So if you look at all the headline numbers of GST collections or the consumption demand or auto sector, monsoon, at the same time there are recovery signs in the rural economy as well. And also this is corroborated by earnings, particularly of banking, financial sector, IT sector, as well as capital goods, that the momentum has been very strong. So India seems to be a sweet spot in this global economy. And coming to NBFC sector in our company, I think NBFC sector also has come out of a long crisis, which began with IL&FS and then a few more other corporate defaults and COVID. And the sector seems to have consolidated, and now the liquidity as well as credit demand is improving. The environment is becoming a lot more positive. Coming to Iifl, I think we had a good quarter. So our loan growth of the core product. Now I would like to emphasize more because these are the products where we are focusing for growth. And now they account for almost 95% of our portfolio. Growth was 26% in terms of loan AUM, and the pre-provision operating profit was up 33%. We had higher provision this time again, and the post-provision profit before tax and profit after tax were up by about 24%. So the provision requirement was higher as we have microfinance pool and in fact close to 400 crores which was restructured, that came out of restructuring in last quarter. I mean, it would have come, the payment would have become due last quarter, maybe some in this quarter, and where we are seeing some stress, and we've been conservative. We provided for it aggressively. We've taken about 100 crore rupees additional provision in microfinance. But I think what is noteworthy this quarter is that NPAs have started falling, and GNPA, that number which was 3.2% at March end, even following RBI's stricter norms, which, although RBI has given some discretion, but we continue to follow the norms that will come in force very soon, maybe by September. And with that, our GNPA number was 2.6% for the entire book. NNPA, or the net non-performing assets after provision for stage 3, was 1.5%, down from 1.8%, and provision coverage ratio has improved and is now 137% as against 123% in the previous quarter. Our net gearing, which, if you net off the cash, liquid and cash equivalent and beam debt, where contractually legally is not debt, is around 4.4 times, significantly better than what it has been in last few years. Our capital adequacy for Iifl Limited is 22.8%, a shade lower than 23.9 last quarter. But Iifl Home Finance capital adequacy is at 30.7%, which is significantly better. Almost half of our business now is done by our housing finance company. Operating cost again has gone up quite significantly last quarter. 200 new branches were commissioned and more than 2,000 people got further added to our manpower strength. So our total manpower now has crossed 30,000 mark. And we continue to invest in technology and marketing as well. Along with this, also the annual salary hikes, and in an environment like this, they have been pretty good. So that impact also is visible in the first quarter operating cost. The outlook seems positive because, as I said, that the credit demand is showing strength. The collection and the general credit quality is also improving. Interest rate hike is always a worry for any lending institution, but as far as we are concerned, given our retail small ticket granular book, and even in home loan we operate in affordable housing, relative to the rest of the financial sector, I think we will have better capacity or superior ability to pass on the interest rate hike. I mean, as long as it's in a reasonable band. If it goes up significantly, it can impact demand, but at this point in time, the economic momentum is so strong that it looks like that will be taken in stride. So with this now, I'll hand it over back to Rajesh to take you through details of our profit and loss and some developments during the quarter, and then we'll open it for Q&A. Thank you.
Thank you, Mr. Jain. So in line with the momentum of the previous quarters, our profit continued to grow. The profit after tax for the quarter was highest ever at 330 crores, which is up 24% on a year-on-year basis and 3% sequentially. The major drivers being the volume growth of 22% in AUM and the higher non-fund based income. The PPOP was at 674 crores, again up 32% on a year-on-year basis and 1% sequentially. Our loan book structure is such that 95% of our loans are retail in nature and 67% of our retail loans are PSL compliant, with the exclusion of gold loans which are not classified as PSL loans, but they have other benefits for banks in terms of capital charges. This is in line with our capital optimization strategy that 39% of our AUM is either assigned, securitized or under the co-lending model. The same number for the previous year for the same period was 34%. Since April 21 till June 22, that is a period of 15 months, we have added almost 11,000 employees and over 1,000 branches. This has obviously affected our cost to income, which has increased to 43% in Q1 FY23. Last year, same quarter, 38. But the expansion has paved the way for accelerated growth in the future. The annualized ROE continues to remain above 20% at 20.5% and largely driven by annualized return on asset of 2.9%. A capital adequacy, as mentioned, at 22.8% is significantly higher than the regulatory amounts. Our average cost of funds for the quarter at 8.5% is 48% down on a year-on-year basis, and in fact 9% down, 9 basis point down even on a sequential basis. At the quarter end, we had liquidity of 5,520 crores, which was adequate to meet not only all near-term liabilities, but also to fund the growth momentum. Two important events took place during the quarter. One is we entered into a joint venture with Open Financial Technologies Private Limited, which is
to collect. But when you're given holiday for a time period and then you come back and it takes some time, then it's a little different situation.
Okay, the half that you expect to recover, the other half.
So now the entire thing has come out of restructuring. So in last quarter and this quarter, I think we'll know exactly the total stressful assets.
Sure. No, just for the half that we don't expect to come back, are we 100% provided there?
We have, I think, 271 crore provision in total for MFI. And so maybe
270, including the 100 this quarter.
Yeah, I think that's the provision that we have, total provision carried for MFI. We may need some more in the next quarter, I guess.
Yeah. Got it. 275 you said, right? Total provision in MFI?
271.
271, but that includes for all assets, not only the stressful assets, but even the normal book.
Got it.
So on these assets, we have provided about 66%, 2/3 of it.
Got it. My next question is on, yields have given across product segments. It does look like your customer is being able to absorb the higher rates. And like you said, you probably have a better ability to pass it on. But I just want to get a sense of the competitive landscape in the sense that is competition being rational and has everyone raised rates in, the core products in home, in gold, in business loans also?
No, you're saying competitive pressures on the yield, on the interest rate?
Has everyone been rational enough to raise rates to the same extent, or are people?
Yeah, I think it's a good question. So in gold loan, in the last financial year, almost from September to March, people were actually quite irrational in terms of the interest rate that they're quoting, like 49 basis points per month with 6%. And many of these players have cost of funds more than that. And they thought that they'll get the customer and they'll be able to raise the price by some default or whatever. But then it doesn't happen to that extent, and many of these. So I think the industry and this cutthroat competition in gold loan is easing now because most of the players are now raising money and becoming rational. So one is that rationally increasing the price, say 90 basis point bank rate has gone up, the interest cost might have gone up by a certain basis point. That is one part of it. The second was that teaser rate and trying to, and that was like spoiling the market. That tendency has reduced significantly.
Got it.
See, 50-100 basis point price, pass on in this industry is never difficult. But what was challenge in the last, 1 year was that many players were coming with teaser rates which are completely irrational, below their cost, and obviously customers actually sees this over 6 months, 9 months that the rate that what was promised to them when they took the loan and actually is very different. So I think that tendency is getting away, and which is a good sign for the industry.
And in home and business, are people raising rates like we have?
In home loan, I think one rate hike has been done, so in home loan, typically what happens that maybe Monu is there, Monu can answer this. Yeah. The first it goes into tenor, but if it gets into EMI, then Monu, why don't you explain the home loan?
Home loan. Hi, Sukriti. So I think your question was that has the industry also moved in tandem with the interest rate increase, right?
Correct.
Yeah. So it has moved in tandem, and right through, whether it is the public sector banks or the private HFCs or private banks, everybody has moved in tandem. So the difference, everything is moved in tandem. So there is no widening of the gap created by us increasing the rates.
Clear. Monu, while you're here, also the business loan strategy is not very clear to me. I think a few quarters back, you all have said that you're going to start focus on this. Is it part of the growth portfolio? Because I do see that it does seem to lag the other core growth segments. And what do you want to grow here? I think, do you want to run down the unsecured book? Can you just re-explain the strategy? I think I'm repeating maybe you've covered it before.
No, one thing, you are asking about strategy for housing finance company or for the group?
No, the business loan.
Okay, so business loan, if you see 73% is secured, and So in business loan, there are two parts of business loan. So one is which we do through HFC, which is led by Monu, where it is mortgages against the loan against property. The other is we do digitally, which is unsecured, which is done through parent company, where also significant part of it we try and get it insured, but there the ticket size is small and loans are unsecured. So I think what we are trying to do digitally is more focused on unsecured, but what we are doing through our network and particularly the housing finance is mortgages. The split is around 70-30, 70% is secured and 30% is unsecured. Both the segments will grow.
Okay, and the open will come into your digital unsecured.
Open will come into unsecured to start with, but over a period of time we can get leads from there for secured home loan also.
Okay. Can I squeeze in one more?
Please go ahead.
So at 15% tier 1, do you think, I know the regulatory limit is much lower, but you never want to go there. So do you want to, is the fundraise likely in the parent in this year?
In terms of, no, I think given the co-lending model and the co-lending and assignments, probably they gather momentum in the second half. We won't need capital. And actually, the capital that we have raised in HFC, we have to make sure that that is also utilized productively and is leveraged adequately so that we generate enough ROE. So at this point in time, there are no plans to dilute equity in the parent.
Got it. Thank you so much.
Thank you. Next question is from the line of Amit Mantri from 2.2 Capital. Please go ahead.
Hi, Nirmalji. First of all, congratulations on a very good quarter. My question is on the provisions front. So this quarter, we have done almost 2.9% of the book on an annualized basis as provisions, and large part of that is microfinance. So what is the credit cost guidance for the full year that we have now? Because I think last quarter you had given a credit cost guidance of 1.5% for this year. So as of now, what is the guidance for the full year?
So, actually what you're saying is right, that the provision is higher than expected and almost like 100 crore rupees of additional provision in MFI. So I think now it should be between 1.5 to 2% for the whole year. See, if you see now, the provision is around 250 crores on a 52,000 crore book, and the year. So full year, I think we should be anywhere between 1.5 to 2%.
Okay. So this provision is on the own book, right? Which is almost around 34,000 crores. So because the rest of the book is anyway, we don't take the risk on the asset.
I think I should stand corrected. What you're saying is right, that the provision is on own book, which is 35,000, and even the percentages are calculated on that basis.
And on you, so now in the presentation you have guided that even another 2-3 quarters you will continue to see a high rate of provisioning, and after that it starts tapering. So
historically, what you're saying is right. That's why I'm saying that we may end the year with 1.5 to 2% because allowed to take some time, and then they asked to come back as things become normal. But we should be in line with the industry. I think, at least in terms of, and what we have done in last quarter is that we have increased our collection force. We have also, in terms of teams, we have separated the sales and collections. So some of the people who are earlier in sales, we have identified them collection, put out a proper incentive scheme for them. So we want to handle this on a war footing so that this gets resolved properly in next 1 or 2 quarters.
Okay. Okay. Thank you very much. I'll come back in the queue.
Thanks.
Thank you. Next question is from the line of Harsh Shah from L&T Mutual Funds. Please go ahead.
Yeah, thank you. Congratulations, Nirmal Jain and team, for the good set of results. Just couple of questions. Firstly, on few of your business segments, like for example, gold finance, how has been the competition intensity now, and what has led to increase in yields on quarter-on-quarter basis?
Competition intensity is easing, and the cutthroat or I spoke about it, some absurd kind of prices, they are now going out of the market. So what happened is that these teaser schemes, we also sort of tried to follow the industry, but very quickly we withdrew them in the last quarter itself, and we realized that even the volume growth is slower sometimes, and we have to sacrifice something, but we'll rather be. And as our tagline is a Seedhi baat, will be more transparent and straightforward to the customer that is interested rather than say something else and charge something else. And so last quarter we suffered. This quarter we are a little bit back, and hopefully yields should improve a little bit from here also.
Correct. So I was asking from competition because of the perspective that there are other NBFCs, like for example, yesterday Bajaj also very aggressively commented that they are now starting to open standalone gold loan branches aggressively, and also will offer gold loan in its existing branches. And at the same time, though customer base is different, bank intensity continues to remain same. Earlier there was this hypothesis that once such kind of competition is seen, you come down the yield curve, and overall NIMs and ROA in this business segment will get depressed. So does this philosophy still remain the same, or you think that from your overall business dynamics can improve and we can generate superior returns versus last 1 or 2 years?
So our yield actually compared to the larger gold loan players has been lower actually historically. Secondly, what we have learned in the last 1 year, this gold loan competition drama and the cutthroat pricing, that the market is so vast and the customers is looking for many other things. So it may not be the wise thing to fight on price, and if somebody is reducing the price and you just panic and do something. So there'll be some pockets where you may have some volume sacrifice, but there are some other pockets where you still have your strength in terms of brand, service, and customer connect. So I think we would be continue with the fair pricing. And actually, see, in gold loan, what happens, people think that 17-18% price is very high and a lot of margin. But what people don't realize is that the operating cost to loan is also 6-7%. It's not something, or it can anywhere between 5 to 8% depending on the scale. So like Muthoot kind of large players might have 5% or close to that, and the smaller players or volumes are lower than can be 7-8% also. So it's not that 17-18% is straight away going into margin. So if you do pricing which is more intense or like lower, then you discover that business might become loss making for you. So but whatever we are seeing, that we have our geographies, our areas, our branches, and our brand and connect with the customer, we should be able to maintain.
Okay, and you had mentioned that you have opened around 200 branches. Any specific breakup? What kind of businesses these branches will cater to?
Out of these 50 branches are for housing finance. So now, housing finance, we have only about 330 odd branches. So what we have done is that we have started, so relative to what base we have, we are scaling up a little faster in housing finance because as Adia money comes in, probably Monu and his team will have more ammunition. Monu, you want to talk about it?
Yeah. So thank you, Nirmal.
Expansion plan?
Yes. Thank you. So we are, Harsh, looking at expanding our footprint in HFC business, which earlier was was moderate. And with this ADIA money on the anvil, we are moving to tier 2, tier 3 towns in specific states. So we believe that there's a vast opportunity out there for affordable housing, and we should see some serious scale up of the housing loan business in the coming years.
So other than that, they were for microfinance and gold loan also.
Understood. And just last question from my side. Your cost of fund has come down this quarter on a quarter-on-quarter basis. So was it repricing? Was it smart ALM management? What was it?
See, it has come down only by 10 basis points. So if you look at, people are talking about interest rate increase, but the current interest rate even after increase are lower than what it was, say, any time before 2018. So what happens is as the older loan gets repaid and we borrow now at a relatively better rate, the interest basically it comes down. And also, as our financials have been consistent and our credibility with the bank, and banks have their own, and the lenders have their own scorecard, are able to negotiate a little better as the liquidity is improving.
So what's the outlook for cost of fund when you're entering Q2 and
If the RBI increases the rate and the liquidity is tightened, the liquidity is a very important factor, just not the RBI rate. So there can be some impact. So I don't think that if the interest rates are taken higher across the system and across the economy, it will remain aloof. But hopefully we should do better than our peers.
Understood. Just one last thing that I want to squeeze in if I can. Since we are very aggressive on co-lending and off book, and also we have great tie-ups with this bank, does that side of the business help us getting a better pricing on our liability side? Our relationship with them have significantly got better over the years because of the...
Yeah, relationship is good, but yes and no, because even their rates are tied to MCLR. So like in case of home loan, we take a price increase for the customer. So even that goes to banks also or any other. So the co-lending by itself will not help reducing or increasing cost of funds. But only good thing about co-lending is that is the loan term or financing is coterminous with the asset. So supposing you are giving home loan for 15 years. It's very difficult to borrow for 15 years in Indian market because the market for long-term borrowing doesn't exist for corporates here, or is very small, very thin. But when you're doing a co-lending, then it almost becomes like funding for 15 years, but you don't have to again refinance it. So for, it's taken care for the entire tenure of the loan, whatever it be. I mean, it gets prepaid, it can get shortened, but so the co-lending advantage is that the asset liability matching is automatic and 100%.
Understood. Yeah, that's it from my side. Thank you for the team and all the very best.
Thank you.
Thank you. Next question is from the line of Saptashri Chatterjee from Centrum PMS. Please go ahead.
Yeah, thank you and congratulations on a good construction and real estate business. Last quarter, I think we had around stage 2, stage 3 together around close to 250 crore exposure. This quarter, this has come down drastically. Can you please give up the breakup of write-off and recovery in this?
No, it's difficult to give breakup of write-up and recovery, but some instances we written off and there are some, there's a Hello?
Hello? Yes.
Yeah, it's a combination of both the things. Sometimes you have part recovery and part you write off kind of thing.
Okay, sure. Second question is, we have I think high coupon dollar bond of around 24,000 crore. Earlier you have talked about buying it back, but can you please talk about how much quantum and maybe timeline for buying this back?
2,000? No,
24,000.
no, 24.
2,400, I think, right?
2,400 crores. Yeah. I think what is outstanding now?
323 million.
323 million. So we had done a 400 million total issue, out of which we bought back 323 is outstanding, and which is due in April next year. But what we plan to do is that we'll try and buy back more, and so that by the time the maturity comes, the amount outstanding may not be very significant.
Okay, sure.
And they are fully hedged.
Okay. And in the annual report, I have mentioned that in the investments book, we have around two exposure of total 1,000 crore in the Iifl 1 value fund series B and C. Can you please talk about which are the constituents and how the accounting of income from this book will come?
So these are the some assets that we transfer to the fund primarily, and the accounting basically is done based on the fair value, based on NAV. Or really, who does it? It's basically there's a fair value NAV done, so the accounting is based on NAV. So every quarter NAV is computed, and based on that accounting is done.
Okay, so every quarter it will come under the non-fund based income, right?
If around if there's a change in NAV, that will come there.
And this will be majorly real estate exposure.
Yeah.
Is it correct? Okay.
That's.
And one last thing is, in the AUM, can you please quantify how much would be floating and how much would be fixed in terms of interest rate?
I think we have interest rate will be home loan and LAP are floating primarily, and other than that, gold loan will be fixed. But there also we have, in a way, that way everything will be floating because we'll always have flexibility to increase the price. But practically speaking, home loan and LAP are floating, and the smaller tenure loans are fixed.
Understood. And in one of the slides there, you report the portfolio yields across the state segments. Does it also include the assignment income, or it is only pure interest income?
No, not assignment.
No, this is interest income. This is on book asset.
Okay, sure. Thank you so much, and all the best.
Thank you. Next question is from the line of Ray Ponda from BCP Securities. Please go ahead.
Hey, good day, everyone. I believe some of the persons just raised one question is actually in regard to the 23 notes. Did I hear right that you guys intend to gradually bring it down?
No, sorry, can you repeat, please?
No, it's in regard to that 2023 notes that's maturing later on in April, yes. Right? I believe somebody raised that question. I just want to make sure that I heard that right, that you guys intend to gradually pay it off and don't plan to extend that notes any further. Is that right?
Yeah, that's right. So we will be able to pay it off based on RBI guidelines, which allow us basically. There's a little complicated formula by which is calculated how much you can buy back. But if you can have ECB, which is external commercial borrowing dominated in dollars, you can use that money to buy back. So we keep, I think, so at this point in time, we don't have any intention to renew the dollar bond because the cost is significantly higher than our borrowing cost locally. So what we intend to do is that we'll pay it off gradually, and whatever is balanced, we'll pay it off on the maturity date. That's what our current plans are. You're right.
Understand. It appears that India is pretty close to the other remaining emerging countries in Southeast Asia. It seems that a lot of them, they either redeem it through sort of local loans, or they just somehow have extra cash and they will intend to pay off as fast as they can. That's how I interpret or how I see it now.
Yeah.
Yeah. So, Ray,
okay, that's all.
Thank you. Bond, yeah. So if you see the 323 million that is outstanding, and in terms of liquidity that we have as of June end, that's about $700 million. So while we plan to buy them back before their maturity, but on the due date also, it should not be a problem to us to redeem them because of the rupee liquidity that we have on our balance sheet. So RBI rules prohibit us from prepaying it using rupee liquidity, but on the due dates, we can always use the rupee liquidity that we have.
Understand.
Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Vivek Ramakrishnan from DSP Mutual Funds. Please go ahead, sir.
Good afternoon. My question was, I have two questions. One is in the capital adequacy ratio calculation itself. It has decreased from 16 to 15.3%, 16 in March. And if you see your loan book and securitized book, I think you have to provide capital for securitized book also, has barely grown. So what explains the dip in capital adequacy? And given the fact that they are doing co-lending, would gearing be a better ratio to look at your company? That's question number one. And question number two is, I heard Nirmal's remark about the strength of the economy. Do you expect collection efficiency to go over 100% as going the next quarter, because a lot of the COVID-related problems will be over, and with that bring down the NPA numbers? Overall, it will take a little time. I can understand that because there should be 1-2 payments behind. But do you expect the collection efficiency to go beyond 100%? Thank you.
So collection efficiency, technically, if it goes above 100%, then we'll have to come down because it can't remain over 100% forever. So the way they calculate is that the overdue amount and the due amount and what you have collected. So it can be over 100% only for a short time period, not for a longer time period. And only if it was lower, then it has to be bounced back to above 100 to catch up. And about your question about capital adequacy, Rajesh, maybe you can explain.
Yeah. So Vivek, this capital adequacy is obviously for the standalone company. And in the standalone company, our loan book primarily comprises of gold loans. Quarter one was a bit subdued, just like any other quarter as far as assignment, though the volumes were high, but compared to, say, March end or the amount that we distributed or the assets that we originated was a little subdued. So our gold loan assets were higher to the extent of 1,000 crores on balance sheet higher. And kind of that explains it. But then with the increased level of increased level of assignment in the second quarter, which is the current quarter, they should fall in place back to the earlier levels.
Okay, great. Thank you very much.
Thank you.
Thank you. Next question is from the line of Ayush Vimal from Clearview Capital. Please go ahead, sir.
Good afternoon, Mr. Jain. Congratulations on a great set of numbers. I had two questions on the gold loan book. The first question is, what is your outlook on the gold loan book in the light of falling gold prices? The reason I'm asking this is because a lot of the larger gold companies seem to have derived their growth over the last 4-5 years from the change in prices of gold rather than tonnage. So I just wanted to check how it's going to impact us in the future if the trend continues.
So the gold loan price, actually in India, the fall has been lesser than the global because the duty has been increased. But if the gold loan prices continue to fall, obviously your ability to loan on the quantum of gold that you or your customers have reduces. So that will have a negative impact on the growth, and the growth can slow down for the gold loan industry as a whole. We should be able to gain market share in the organized sector with our increased network of branches. But of course, if the gold prices, what you're saying is right, that the last 2-3 years, and particularly 2021, the significant increase in gold loan assets, of the gold loan companies was primarily because of the gold price increase. So what happens in the tonnage growth, what you can also monitor for most of the players is where I think that the volume growth. So that's for the industry, the organized sector, I think we have been doing better. We have about 10-12% to gold tonnage growth in our vaults. And hopefully with the expanded network, we should aim a little higher. But I think, your point is correct. That if the gold prices go down, the industry growth will also slow down.
Thank you, sir. One more question that I had on the gold loan book is I see about 20% of the loan book exposure to Gujarat. I just wanted to check on whether we have lumpy loans in the book. If you could tell me what is the proportion of the outstanding loan book where the ticket size has been more than 1 lakh, that will be very helpful.
No, Gujarat is, so what has happened is that we were a little late entrant in the gold loan, and strategically we saw that the earlier players were very widely entrenched in South. So we started with Gujarat and made that as a flagship state, so we have more than 350 branches in Gujarat alone. And the gold loan book is very granular and distributed, so there's no lumpy exposure at all in this. So any of our gold loan book anywhere in the country is all retail.
Got it. I think that's very helpful. So thank you so much.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. Now, sir, I just wanted to understand first up on your credit cost. Now you mentioned about 2% of credit for this year, maybe 1.5 to 2%. So even if I take the higher band of that 2%, so we are looking at maybe 750 crores kind of a credit cost this year with the 25%.
800 crores, the book will also grow,
Yeah, assuming the 25% growth in book. Now, so 250 crores we have already done. So we are left with 160 crores kind of a credit cost per quarter, or 160 to 170 crores for the remaining 3 quarters in this year. So ideally what we are saying is that from this quarter onwards, our credit cost should normalize. Is that the right interpretation?
So this quarter onward, okay. What the way logically should happen, but nobody has precise view on the future. So this quarter onward, next quarter, all 3 quarters, we should see it going down.
Provision should go down quarter on quarter, right?
Yeah.
Mm-hmm. And overall, we are looking at 2%, 1.5 to 2% for the entire year, right?
Yeah, that's right.
Okay, understood. And so my second query is regarding, I think we have been guiding about AUM growth of 25%. Now, a similar growth on PPOP is what we might be looking at?
Sorry, what are you saying?
A similar growth in PPOP is what we might be looking at?
Yes.
Okay, fair enough. I got it. That's it from my side. All the very best. Thank you.
Yes, some of the impact also came because of deemed NPA, which came from RBI last quarter. So that also has led to increase in credit cost.
Thank you. The next question is from the line of Mudita Nahar from Abacus AMC. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. So just a couple of questions. So MFI book in the last quarter, due to the RBI guidelines, the disbursement was quite slow. So how is the disbursement picking up from July, sir?
So actually last quarter we were focusing a lot more on setting up collection infrastructure and collection apparatus in place. So this quarter onward, the disbursement should pick up.
So how much would be the percentage wise, sir?
So if you see microfinance disbursement, last quarter we did 1374 vis-a-vis 2500 crore in the previous quarter. So I think we should look at something like 2000 crore as a normal number in a quarter.
Okay, sir. And sir, on the employee expense, quarter on quarter, the employee expenses increased drastically by 10%. So is there any involvement of variable expense in this quarter?
No, we take our salary increases, make it effective from 1st April. So this year, I think 7-8% of that would have come because of salary hikes alone.
Okay. And on the securitization book, in the last 7 to 8 quarters, this is the lowest that we have done securitization in a particular quarter. So any color on that, sir?
See, because the co-lending has grown now, so that obviously is eating into the book that could have been securitized. Yeah. So I think if the co-lending and assignment grows, then obviously securitization is not our focus.
Okay, so going forward, what is the trend that we can expect out of this one?
So you should look at co-lending, securitized and assigned together. These are all 3 off book. And I think our focus will be more on. See, sometimes what happens that there are, like, say, foreign banks, they only take securitized and they don't take assignment or co-lending. So they are offering a good rate, then you can do a transaction there. So, I think you should look at the three together as one pool, as off book.
Okay, sir. That's it from my side, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Akhil from Axis Mutual Funds. Please go ahead, sir.
Yeah. Thank you, sir, for taking my question. I joined in late. Maybe you may have answered this question just. So wanted to understand this decline in stage 3 book. Last time, I think we also had something which was classified as a deemed NPA. Now, has that subsided into the stage 3, or we have done away with it? Sorry, just wanted to understand what has happened.
So in the stage 3, we have taken some write-offs and we also provided for it. So, and some resolutions have been done. So it's all put together. What we are seeing is the decline, from 885 from, I think it was about little over 1,000 last quarter, 1,074 to 885.
Okay. No, last time if I combine your normal stage 3 and stage 3, including the deemed NPA, it was closer to 1857, which has now come down.
No. It was 1,074. So 1,074 was combined number.
Achha, 1,074 was the combined.
I think it's adding the two. This
But see, if you see the slide, so this 1,074 includes 783.
Okay. I get your point, sir.
Yeah, so that number combines both the things. Maybe it's not presented properly, but so 1,074 is all. It's not 1,800. So there's a little bit of decline, maybe 10-15% this quarter.
Get it, sir. Get it. So last piece on the construction book, where we have seen a decline in your stage 2 and stage 3. Could you throw some light on what exactly has transpired? Is it a write-off or is it a repayment that has actually happened?
So we are doing certain aggressive settlement and write-offs also to bring this book, under control.
Okay. So largely, could we ascertain this to, let's say, write-offs on your, because the book has actually also declined. I think last time the book was closer to 2,900 crores, which this time has come down. So
it's partly, it's both the things. It can't be entirely, so it's both, it's combination of the two things.
Sure, sir. Thanks. That's all from my end.
Thank you. Next question is from the line of Anusha Raheja from Dalal and Broacha. Please go ahead.
Yeah, thanks for taking my question. I just want to understand, you said that you're looking at AUM growth of around 25% odd. So I want to understand where the growth will come from, because with the drop in the prices of the gold, AUM growth will be very difficult to come there. And on the MFI portfolio, also the growth will not be that significant. So large part of growth, if AUM has to grow by 25%, I think home loans will have to grow at a much higher rate. So do you foresee that that higher growth is possible there? What will drive this?
So, okay. First, gold loan will grow maybe at a slower pace in case gold prices continue to fall significantly. So there are two assumptions here. First of all, that gold prices will fall, but we don't know about it. And even if gold prices fall, then we may grow slower. Our tonnage growth will plan at least 12 to 15%. So that is one. Secondly, home loan will of course grow, so it should grow stronger. But even microfinance now will start growing because, as I said, the disbursement in the first quarter was lower as we are focusing more on collection. But the industry is growing, and microfinance also should see good growth. And then the fourth core product is business loan. There also, I think the growth will be there. I don't think that it will remain static. It will also grow.
Okay, so over the next 2 years time frame, how do you see, this number panning out?
I think home loans should grow faster because that is how we got that company also funded by equity. Gold loan is again a little bit dependent on the gold prices, but given our expanded network, we should grow that also. MFI industry looks good for next 2 years, because I think it's past the difficult phase for last 2-3 years, so these should grow. And in terms of business loan, the base of is not very big, but I don't see any issue there also in terms of growth. So that will all look good, but in terms of you can probably say that relatively home loans should grow faster, and microfinance followed by that, and then others.
Okay. Also, on the cost side, over the next 6 months to 1 year, there will be increase in the cost, right? So, assume that you pass on to that cost. Will it impact growth? And on that higher, lending rates, how do you see your book from asset quality standpoint?
So the cost of borrowing, how much it goes up? It goes up. This is again my personal view, and everybody can have a view on this because nobody knows future with certainty. So if it goes up by 50 basis points or whatever, I think it will be taken in stride. Now, if the cost goes up by 150 basis points, it may impact and more maybe the mortgage or the home loan demand because that is little rate sensitive more than others. But more than rate, one also has to look at the economy because the interest rate hike has impact on economic growth as well, and that has in turn impact on the demand for credit. So many of these things are linked, but the way things stand today, the economy seems strong, and then hopefully everything should be good.
Okay. Thanks.
Thank you.
Thank you. As there are no further questions, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everybody for being in the conference, and in case you have any more queries or any questions, you can always reach out to our investor relations or CFO's department. Thank you and have a good day ahead. Thank you.
Thank you. On behalf of Iifl Finance Limited, that concludes this conference. Thank you for joining us, and you may disconnect your line.